Hi, everybody. Here's my scenario on why house prices are going to peak this summer. I'm going to look at Phoenix, where I have a lot of extra data. And the number one is that Phoenix has a really strong trend for home prices to peak in June of each year. So let's look at that data. The green line are prices. So you can see first half of the year they go up, then they're flat for the second half. First half up, flat second half. First half up, second half flat. Up, flat, up, flat, up, flat. And then in 2019, it didn't happen, but interest rates were falling that entire year, which led them to go up. And they continued going up in 2020. The entire year, mortgage rates were falling, and that allowed prices to continue going up. That's not going to happen now because we can look at 30-year mortgage rates. They bottomed out in December, January. So these fall here caused a ton of price increases for homes, but they haven't been going down anymore. So that is going to have a big influence for many, many months to come, but nevertheless, that influence is fading. It's not getting bigger anymore. It's getting smaller. So that's one of the reasons. It's just it's traditionally that the market in Phoenix tends to go flat in June. And in fact, we can go back to here. Remember, here's the big green price increase in 2005. What year was this where it flattened out? I mean, month. It was in June, just like everything else. It's in June they tend to flatten out. So my guess is July prices will be similar to June. That's the scenario. Another reason that is because in Phoenix, particularly, we have a second home market, the vacation home market. Those people do not buy in the summer. That's pretty rare that they buy in the summer. So that market really slows down. And that second home market was actually an important market because of the COVID market. The COVID demand increased the demand for second homes. So that's going to get hit strongly this year, like every year. So that's part of that scenario. What's another part? Second home falls, right. Mortgage interest rates aren't falling anymore. That's the big thing. Mortgage interest rates, as I mentioned, are falling here, and we don't have that tailwind anymore going. And I think that makes prices more sensitive to the normal seasonal flattening out of prices. Changes in demand by COVID and isn't changing anymore. Obviously, when COVID happened, people decided they wanted bigger homes, they wanted more vacation homes, but that's done. That's not changing anymore. The market may be adapting to those changes from COVID, but the market isn't changing. It's just, I mean, the demand isn't changing, but the market is adapting to the changes. Another thing is prices are already up a ton, and we could get more, the market could be more sensitive to prices. You could see here that some people are going to give up and say, forget it. And so it could be just a small decrease in demand could flatten out prices. That's the scenario. Mortgage forbearance. Mortgage forbearance is another issue. We see that that's it keeps being delayed, but once we do start seeing mortgage forbearance, it could start having an impact by the end of the summer, and that would cause more homes to hit the market. Those people have had their homes appreciate a ton, so even if they haven't been able to pay their mortgage, it's worth a lot more, and some of them will decide just to sell it. And although the number of homes that are going to hit the market because of the getting rid of mortgage forbearance isn't going to be huge, it will be an increase. And although if inventory, the number of homes for sale is low but going down, that has a very different effect than if it's low but going up. Totally two different ballparks. And in this scenario, by the end of the summer, we'll start seeing some forbearance houses hitting the market, even though inventory is low. If it's going up, that has a very different effect than if it's low and going down. So that's the scenario that I have for it. And if you want to know why I could be wrong on that, then a different scenario, not that I'm wrong, just that that scenario is wrong. And then has another peak here would be um, basically the number one thing is just looking at prices. When you look at real mortgage payments, they're not that high. We're kind of like where we were in 1990, depending on if you look at the Case-Shiller numbers adjusted for inflation and interest rates. You know, they're not cheap, but they're not crazy. They're more along 19, you know, S&L bubble levels at this point, because the latest number here we have is February. So by the end of June, it should be more like late 1980s. Oh my God, I'm all over the place. Take care.